Hello. The next presentation will be by Yasin Mimir from the European Stability Mechanism. Yasin, do you hear me?
Yes,
Hello?
yes, I can hear you. Yes,
Can
can you hear me?
Yes, we hear you very well. Can you try to share screen with us so we know that things
Actually,
work? Yes, we
actually,
can.
I started sharing. I start sharing.
Excellent. Yeah, we see everything very well. I can
Okay.
I can just warn you that you have 25 minutes to talk and 5 minutes for questions. And 5 minutes before these 5 minutes, meaning in 20 minutes, I will have to interrupt you and remind you, unless you acknowledge it somehow in your presentation that you have like 5 minutes talk. So the floor
Thank
is
you very much.
yours. The floor is yours. Thank you.
Thank you. Thank you very much. So first, I would like to thank the organizers for including our paper into the program and for giving me the opportunity to present our work on this exploring the euro area exposure to the risk of financial fragmentation. So I'm also so sorry that I won't be there with you in South Africa due to the work-related obligations, but I will try my best to basically keep you like awake with the presentation. So this is a joint work with my ESM colleagues, Gergo, Alexander, and Graciela. And then, of course, the usual disclaimer applies. The views expressed here are our own views, not the views of the ESM or of the ESM policy. Okay, so let me start with the motivation of this work. So as we all know that like as geopolitical tensions increase, there is a growing concern that the global economy and then the financial system may increasingly become fragmented. So although global financial integration, which is basically the sum of which is basically defined by the sum of the gross external financial assets and liabilities as a share of GDP, as on the right-hand side graph, you see that it has increased substantially starting from the 1990s. It has recently stopped and even fallen, reflecting weaker capital flows to and from advanced economies, including the euro area. So among other things that has led to this, we also suspect that the geopolitics or geoeconomic fragmentation could be argued one of the potential drivers of this decline in this global financial integration recently. And indeed, when we look at data, we see that the cross-border investments seem to be partly shaped by the geopolitical considerations. So on the right-hand side, we basically display the allocation of these cross-border investments into into the recipient country by a source country in excess of the world portfolio for different ranges of bilateral geopolitical distance. So here we see that the basically with the rising tensions, the investors may further scale back their investments into the political distant countries. So here we see that the investors increase their foreign direct investment, portfolio investment, or the bank intermediated investment into less geopolitical distant countries, while they reduce their portfolio positions into more geopolitical distant countries. And so with this motivation, we see that the geopolitical tensions has become increasingly a risk to the global economy. And then our research question that we would like to ask in this work is that is this financial a fragmentation relevant for the euro area? So we would like to see whether this geopolitical divergences between countries are empirically relevant for the euro area cross-border financial ties. So in order to answer these questions, what we do is that we first document the euro area's cross-border financial exposures to countries with different geopolitical alignment and how much is at risk. And then we found that the euro area is broadly insulated, although there are some non-negligible pockets of vulnerabilities, exposures that can be important. And then we would like to investigate the relevance of geopolitical divergences in bilateral financial linkages by focusing on the cross-country differences. So what we do is that we rely on the gravity type regressions, and then we found that the geopolitical factors do shape financial ties, especially for the portfolio investment involving the euro area countries. And then what we do finally is that we assess the impact of this like a global geopolitical risk shocks on the euro area portfolio flows. And then here we rely on the Bayesian VAR models with like a regime shifts of geopolitical risks. And we found that the euro area appears to have safe haven characteristics when a geopolitical shock hits. However, the outflows from the foreign investors can occur in a state of high geopolitical risks. So we rely on regime switching VAR models to basically show this result. And of course, here we rely on the RISE toolbox to answer this question. Okay, so then let me just briefly touch upon the various channels that this geopolitics impact the economy through various transmission channels. So as also based on the literature, we see that the geopolitical risk can affect the real economy through trade and supply chain disruptions, by barriers to technology transfer and migration, weaker consumption, investment, and higher saving. And this leads to lower productivity and economic growth and higher inflation. On the other hand, what is the effect of this fragmentation on the financial markets is that we see like a lower risk appetite by investors, which lead to higher risk premia in the geopolitical distant countries. And then it also leads to fragmented capital flows, increasing the market volatility, which leads to tighter financial conditions and more costly borrowing for the sovereigns. And it also can lead to decoupling of payment systems and regulation. And of course, there is also feedback between real economy and the financial sector and the financial markets is that, of course, more costly funding leads to weaker lending and deterioration in the asset quality, which leads to weaker profitability and the risk to solvency. So in this presentation, I will only focus on the financial markets part, and then I will focus on the fragmented capital flows part and the tighter financial conditions. But we see that the impact of the geopolitics and geoeconomic fragmentation is much broader than what I can cover in this presentation. Okay, so then let me go over how we measure this geopolitical alignment. So we rely on the literature and then many works by the IMF and the World Bank and the European Commission. And then so here we categorize the countries into geopolitical risk groups based on their votes at the United Nations General Assembly during 2022. And then what we do is that we pick the US and China as the two reference points, given their economic size and the recent trade tensions, and place other economies on a spectrum based on this voting behavior. So this is done in the literature in a standard manner, and this is achieved through a data-driven mechanical approach. So we rely on this S scores paper by Signorino and Ritter, 1999, to assess the similarity of countries' voting patterns with the US and the China. And then we categorize the countries such that the countries voting similar to the US are allocated to the group of countries that are geopolitically close to the US, while the countries voting similar to the China are allocated to the group labeled countries geopolitically close to China. And then if there are countries that do not exhibit any clear alignment towards either US or China, that are basically allocated into the neutral group. Okay, so after we do this a categorization of the countries with the geopolitically aligned and geopolitically distant countries, then we would like to see the exposure of the euro area to this financial fragmentation risk. So the question on whether these geopolitical risks are relevant for the euro area external financing or not, we naturally start by exploring the bilateral cross-border investment data, and then we first dig into the assets and the liabilities of the euro area countries in terms of the FDI, the foreign direct investment, portfolio debt and equity, and the cross-border bank intermediated investment. So as you can see on the left-hand side, the majority of the euro area country cross-border investment are within the region. So here we see that the blue lines are the investment within the euro, blue bars are the investment within the euro area, the yellow bars are the investment within the geopolitically aligned countries, and the pink bars are the investment into the geopolitical distant countries. So here we basically see that the majority of the euro area countries have their cross-border investment in the region, and a sizable portion of these extra euro area positions are with the other geopolitically aligned countries. However, although the euro area appears to be like a resilient to the financial fragmentation list on the first side, we see that there are still like a share of foreign investment with countries more geopolitical distant that are non-trivial. So, and to have the broader perspective, not only in terms of the euro area GDP, but also over time, what we do is that we stack all these four types of investments: FDI, portfolio equity, debt, and the cross-border banking investment, and then we look at the time variation of the investment into the geopolitical distant countries. So if you look at the graph on the right hand side, you see the aggregate gross exposure of the euro area countries in terms of the euro area GDP from 2003 to 2023. The solid line shows you the total extra euro area positions as a share of GDP. And then the dashed like a black line shows you the investment into the politically weighted countries. So here the difference between those two lines shows you the gross exposure of the euro area to the geopolitical distant countries. So this is the exposure to the financial fragmentation list and risk, and then we see that it increased up until 2020. It reached to basically 60% if you look at the difference between these two lines, and then recently it has declined. But still, the exposure is quite high to the geopolitical distant countries. And then what we do is that we basically decompose this fragmentation risk into the assets and the liabilities. So as you can see, the euro area positions at the risk of fragmentation sharply increased over the last 2 decades, which peaked in 2020, reaching the 60% of GDP. And the vulnerabilities lies both in the assets and the liabilities. So on the liability side, they are mostly driven by the increasing holdings of the euro area sovereign debt by the distant central banks. On the asset side, the euro area investment in geopolitical distant countries are largely in FDI. And interestingly, we observe a notable decline in the great exposure since 2020, so showing some signs of ongoing financial fragmentation. And this is mostly driven by the euro area investors recently liquidating their claims in the geopolitical distant countries, but which might also partly driven by the valuation effects. And then if we decompose this aggregate gross exposure into the euro area member states, we see how the euro area countries are differently vulnerable to this fragmentation risk. So, and this naturally depends on their degree of openness. And then here we see that the large euro area countries, those issuing safe assets, have large portfolio debt exposure to the foreign central banks. They also tend to have positive net exposure to the FDI reallocation risk. While the smaller countries like Greece, for example, their exposure mainly lies in the inward FDI into the country. They still appear relatively insulated when we look at the direct exposure, but some bigger countries, those issuing safe assets, are particularly exposed to this financial fragmentation risk. Okay, so after giving you this a motivation and the stylized facts about the euro area exposure to this financial fragmentation risk, what we do is that we basically assess whether these geopolitical factors are relevant for the quantitatively relevant for the euro area. And then here we rely on two types of models. First is the standard gravity type models that are standard in the trade literature that we apply for the cross-border capital allocation. And the main question that we ask is, do investors factor in this geopolitical alignment when they allocate capital to these foreign recipient partners? And does this matter for the euro area member states? Here we exploit the cross-country variation, and then we basically exploit all the bilateral links, focusing on the euro area recipient countries or the euro area investor countries. And then secondly, after doing this cross-sectional analysis, we rely on the BVAR models to look at this question from a time series perspective. So we have some BVAR models on aggregate portfolio flows from and to euro area to quantify the impact of these changes in geopolitical risk on the euro area aggregate portfolio flows. And then here, the most importantly, we differentiate between the high and geopolitical risk regimes using the regime switching models. Because here the investors may change their behavior when they are in high versus low geopolitical risk regime. And then from the results, we will see that that's indeed the case. And then here, again, we use this regime switching BVAR models and use the RISE toolbox to solve these models. Okay, so let me first look at the results from the gravity type models. So here, what we do is that we basically ask whether the investors factor in this geopolitical alignment when they allocate capital to this foreign recipient countries, and does this matter for the euro area? And then here, the dependent variable is the share of the recipient country I's in the source country J's overall cross-border investment, while the main explanatory variable is the bilateral geopolitical distance interacted with the euro area dummy. So if the investor in one euro area country sees that there is some geopolitical distance between the countries that he wants to invest in, then he might change his behavior whether he will invest or not. So here we control for a wide range of bilateral factors, including a geographic distance, global and country-specific time-varying factors that could affect the flow of capital. So here on the left-hand side, you see that the investor countries they tend to allocate a smaller share of their investment into the geopolitical distant countries for different types of investment, like direct investment, portfolio equity, portfolio debt investment, and bank intermediated asset. But here we find the most significant results for the portfolio investment. So we see that the portfolio investments are particularly sensitive to this geoeconomic fragmentation. And then we also, if you look at the graph on the right-hand side, we see that the FX official reserves of the central banks appear to be sensitive as well, but on a smaller scale than the private portfolio investment. But we still see that if the geopolitical distance between the countries increase, then the FX reserves also tend to go down, and this is especially pronounced for the euro shares of these FX reserves. And then what we do is that we basically make a simple simulation of how these sensitivities could affect the portfolio outflows from the euro area if this geopolitical distance increases by one standard deviation. And then here our estimates show that an increase in the geopolitical distance can trigger a decline in the foreign portfolio investment into the euro area. And then this is at the amount of 1.5% of the euro area GDP. But as you can see that this widely varies across different euro area member states, Ireland being the more exposed to this increase in the geopolitical distance, while, for example, Portugal is less exposed to this portfolio outflows if the tensions escalate. And then we can also do a simple simulation based on our sensitivities from the gravity type models on the FX reserves. And then here we also see that basically if the geopolitical distance increases, then the FX reserves of the euro area will be affected and decline by 3.7% of the euro area GDP. So then our main message from this is that the portfolio flows can reverse if the geopolitical tensions escalate in the world. Okay, so then what we do is that we basically look at this rising geopolitical tensions, the impact of this from a time series perspective, and then we rely on a battery of constant parameters and the Markov regime switching Bayesian VAR models using monthly data for the period from 2000 to 2023. So let me start first with the constant parameter models. So here what we do is that we assess the impact of a shock to the geopolitical risk index constructed by Jacobiello and Caldera on the net and the gross flows of portfolio equity and debt. So this index basically captures the threat, realization, or escalation of these adverse events related to the wars, terrorism, or tensions between the countries. And then here we also include a wide range of different push and pull factors that could drive this portfolio flows, like global and domestic pull and push factors that could drive this portfolio flows. And then we basically look at the impact of this geopolitical risk shock. And then here we do a simple Cholesky decomposition to identify the shock to the geopolitical risk index. And then here you see on the first graph in the panel, we see that if we have an increase in the geopolitical risk index, so if the geopolitical risks are elevated, this leads to a decline. It leads to an increase in the global financial uncertainty, shown by the VIX index, which means that basically the investors the risk aversion increases because of the increased financial uncertainty in the global markets, and this also leads to a decline in the euro area stock prices. So the euro area stock prices also decline with the falling risk appetite due to the geopolitical risks. Okay, and then we look at the impact on the portfolio flow. So what does this increase in the geopolitical risk imply for the portfolio flows to and from the euro area? So let me start with the portfolio debt flows. So here, when we look at the impact of this geopolitical risk shock, we see that the foreign investors tend to buy the euro area debt. So here we see an increase in the portfolio debt liability flows as a share of euro area GDP. And then we see that when there's a global geopolitical risk shock, the foreign investors tend to purchase euro area debt. Although our results are less clear for the asset flows, so then the euro area investors do not change their behavior when they invest into the countries abroad. It is statistically not significant, but we see that this geopolitical risk shock basically leads to a reduction in the net debt flows into the euro area. So what is the main conclusion is that the foreign investors, they tend to purchase more euro area debt, but because the asset flows do not change significantly, we see a decline in the net debt inflows into the euro area.
You have about 4 minutes now.
Okay. I have 4 slides or so. And then if we look at the equities, like portfolio equities, we see that, again, if there is a geopolitical risk shock, the euro area investors retrench from foreign equities, while foreign investors appear to buy euro area equities. So then basically investors consider the euro area as safe haven when the geopolitical shock hits, and then we see an increase in both portfolio debt liabilities and the portfolio equity liabilities. And then the euro area investors, they tend to sell foreign equities in the geopolitically distant countries. Okay, and then finally, I would like to basically differentiate between the 2 different types of regimes. So our regime switching framework allows us to detect 2 distinct geopolitical risk regimes, high and low, depending on the level of the geopolitical risk measure. So here the figure shows the probability of high geopolitical risk regime together with the level of the geopolitical risk index starting from 2000. So our model basically have endogenous regime switching probabilities that depend on the level of this geopolitical risk index constructed by Jacobiello and Caldera. And then here we see that the period starting from 2000 is mainly characterized by the long periods of low geopolitical tensions, which is interrupted by the short periods of heightened risks. And then these high geopolitical risk regimes are mainly associated with terrorist attacks wars and escalation of the tensions. So at the beginning of the sample, you see that this geopolitical risk increased because of the war in Iraq or the 9/11 terrorist attacks and so on and so forth. And recently, it also increased due to the tensions in the Middle East and the Russian and Ukraine war. So what does this distinction imply for our results? So our results basically show that the foreign investors change their behavior towards the euro area securities under different geopolitical risk regimes. So although the foreign investors usually tend to purchase euro area debt, which is coming from the constant parameter model, which is also the case in the low geopolitical risk regime, we see that in a high geopolitical risk regime, they can liquidate their debt holdings. So then they can basically fire sell their holdings of the euro area debt if we switch to a high geopolitical risk regime. So then the geopolitical risk shock can lead to debt outflows from the euro area, increasing the risk to the external financing if the geopolitical risks heightens and then we switch to the high geopolitical risk regime. Okay, so then with this, let me conclude. So overall, the euro area appears to be resilient to the financial fragmentation because it has most of the exposures in the euro area countries or in the geopolitical aligned countries. However, there are still like exposures to the geopolitical distant countries are non-negligible and increase over time. And we see that the vulnerabilities differ across different euro area countries. And then we see that the geopolitical distance do shape the financial linkages. So the investors tend to reduce their portfolio investments from and to euro area countries if this geopolitical tensions, the distance increases. And finally, although the euro area appears to have some safe haven characteristics, when a geopolitical shock hits and the global risk aversion increases, we see that the portfolio debt outflows can happen in a state of high geopolitical risk. And with this, let me conclude. Thank you very much.
Thank you very much, Yasin. We come to questions from the audience. Any questions? Any online questions? No? So I'm sorry, we have then to go to the next presentation.
Okay, okay, let me stop. Thank you very much.
Yeah, thank you very much. And the next presentation is by Yuki, and I ran out of paper, so you will announce your presentation yourself. So because I need to start with